Hey there, curious minds. Welcome to the Deep Dive, where we cut through the noise to bring you the core insights on fascinating topics. Today, we're unraveling a concept that's absolutely fundamental to every business, big or small, yet often seems kind of shrouded in jargon.
It really is. It's basically the blueprint of how a company funds itself, and it directly impacts its ability to grow, innovate, and, well, even survive. We're going deep into capital structure, that strategic mix of money that powers a business.
That's right. We've pulled together a stack of sources that cover, everything from where companies get their cash to how they weigh the costs and benefits of different funding options. Our mission today is to distill the really important nuggets, spark those aha moments for you, and leave you with a clear, actionable understanding of what's truly at play here. So let's get started. Understanding capital structure, the building blocks. Okay, so when we talk about a company's capital structure, what's the simplest way, maybe, to think about it?
Think of it like putting together the funding puzzle for a house. You need different materials, right? Capital structure is just that mix of financial materials a company uses to fund its operations and its expansion. These materials primarily come from two big sources: borrowing money, which is debt, and selling pieces of ownership, which is equity. The goal is always to find the right combination,
Mhm.
the one that makes the house strong but also cost effective.
Okay, got it. So let's unpack that first source,
Mm.
debt financing. When a company borrows money, what are some common ways they actually do it?
Oh, there are quite a few ways. Companies borrow for both short-term needs and long-term projects. For quick needs, maybe covering payroll or inventory, they might use things like a short-term bank loan or maybe commercial paper.
Commercial paper.
Yeah, it's basically an IOU issued by a large reputable corporation. It usually matures very quickly, often within, say, 9 months or less. Then for longer-term funding, you'll see things like bonds or debentures.
Debentures. That sounds a bit more formal. What's the key thing we should know about those?
Right. Debentures are essentially unsecured corporate bonds. And the
Hmm.
crucial point there is unsecured. It means they're not backed by specific assets like, say, a building or equipment,
Oh.
which often means they carry a higher interest rate than a secured loan, simply because the lender is taking on a bit more risk. And then you can have subordinated debentures. These take that risk even further.
How so?
Well, if the company goes bankrupt, these lenders only get paid after the senior creditors, even the other unsecured ones. So, naturally, they demand even higher interest rates to compensate for being further back in the line.
That certainly clarifies the risk side of debt. What about the other end, where things are, more secured?
Right. On the secured side, you might see mortgage bonds. These are, well, quite literally backed by real estate or sometimes other specific assets held together. This gives the bondholder a direct claim on those assets if the company defaults. So they're generally less risky and tend to have lower interest rates. And then there are things like leases, which might seem like just renting, but for businesses, certain types, called finance leases, function very much like debt. The company gets to use an asset, say machinery, without owning it outright, but it effectively creates a liability on their balance sheet. It's treated like a form of financing.
So it really isn't just about getting the money. It's about carefully managing that risk-reward balance.
Yeah.
Even things that sound risky, like junk bonds, those non-investment grade bonds with high default risk, they can play a strategic role, right, if the potential return is high enough.
Exactly. If a company believes it can manage the repayments, the high yield might be worth the high risk. It depends on their situation.
That makes the world of debt much clearer. Now let's pivot to that second big bucket, equity financing. What's the main idea when a company goes this route?
Equity financing is fundamentally about selling ownership. When a company issues stock, whether it's preferred stock or common stock, they're selling a piece of the company itself to investors. And a critical difference from debt is what happens if the company gets into financial trouble.
Right, you mentioned who gets paid first.
Yes. Equity shareholders are absolutely last in line to get their money back if the company goes bankrupt or has to liquidate. All the debt holders, secured and unsecured, get paid before the equity holders see a dime.
Let's start with preferred stock.
Hmm.
You hear it called a hybrid security sometimes. What does that actually mean for someone holding it?
It's called a hybrid because it has features of both debt and common stock. Like debt, it often promises a fixed dividend payment. It looks a bit like the interest payments on a bond. But, and here's the equity-like part, those dividend payments aren't legally mandatory like interest payments are.
Oh, okay.
The company's board of directors decides if and when to pay them. They can skip them if times are tough. And another key difference from debt. Preferred dividends are not tax-deductible for the company. That makes them a more expensive form of capital from a tax point of view.
Got it. And then there's common stock. That's the one most people probably think of when they hear stock market.
Exactly. Common stock represents the most basic form of ownership in a company. Common shareholders usually get voting rights, so they can have a say in electing directors and major company decisions. Dividends for common stock are entirely optional, again, decided by the board. There's no fixed promise. When a company issues new common stock, the cash they get is typically split on the books. Part goes into a common stock account based on a nominal par value, which is usually just a tiny legal minimum, like a penny, not the market price. And the rest, the bulk of it, goes into additional paid-in capital. That's the amount investors actually paid above that par value. And again, super important. These common shareholders have the lowest claim on the company's assets in a liquidation scenario.
Okay, this is really useful. So here's a core insight for you, the listener. When a company is deciding between debt and equity, they're constantly weighing this fundamental set of trade-offs. We've got a great summary of the key differences here.
Indeed. Think about these crucial points, these contrasts. Flexibility. Debt offers basically zero flexibility. You must pay that interest. Equity, though, offers flexibility. Paying dividends is optional.
That's a big one.
Huge. Then tax impact. Interest on debt is tax deductible for the company. Dividends on equity are paid after tax. This makes debt seem cheaper on an after-tax basis.
Right, a big incentive for debt.
Definitely. Then earnings impact. Issuing new debt generally doesn't reduce the earnings per share, or EPS, for existing shareholders, but issuing new equity. That often does dilute EPS because you're dividing the earnings among more shares.
Okay.
Then there's financial risk. Debt clearly increases a company's financial risk because of those mandatory payments. Equity doesn't carry that same kind of fixed obligation risk.
And what about the cost to actually issue them?
Generally, raising debt is cheaper upfront. The direct costs, like legal fees and underwriting, what we call flotation costs, are typically lower for debt than for issuing new stock. Equity issues can be quite expensive. And finally, investor return. Debt holders get a fixed return, their interest payments. Equity holders, they get a variable return, maybe some dividends, plus the potential for the stock price to go up or down.
So what does this all mean for you listening? It means when a company chooses how to fund itself, they're not just picking a source off a menu. They're making really strategic choices that impact their risk profile, their financial health, their taxes, and ultimately, their potential for future growth. Understanding these trade-offs helps you better evaluate why a company makes the decisions it does, or even evaluate your own investments. The heart of the matter. Weighted average cost of capital, WACC.
Okay, so we've got the building blocks, debt and equity. Now let's get into how companies actually figure out the true cost of using all this capital combined. That's where this thing called the weighted average cost of capital, or WACC, comes in. What's the big picture behind WACC? Right, WACC. It's essentially the average cost of all the different kinds of financing a company uses: debt, preferred stock, common equity, all weighted by how much of each they have in their capital structure. You can kind of think of it as the company's overall cost of capital, or its internal hurdle rate.
A hurdle rate, that's an interesting term. What does that signify exactly?
It's the minimum rate of return a company expects to earn on any new project or investment to make it worthwhile. If a potential project can't generate returns above this hurdle rate, this WACC, then taking it on would actually destroy value, not create it. So the ultimate goal for any company's financial strategy is to find that mix of debt and equity, that optimal capital structure that results in the lowest possible WACC.
Why lowest?
Because the lower cost of capital means the company can invest profitably in more projects. It maximizes their efficiency, their growth potential, and ultimately increases the overall value of the firm for its owners.
Fascinating. So how do they actually go about calculating this WACC? It sounds like mixing apples and oranges almost.
Well, it is a blend, but a calculated one. The WACC formula takes the cost of each specific type of capital, common stock, preferred stock, and debt, and then weights each cost by its proportion in the firm's total capital structure. And ideally, you want to use the market values of the outstanding debt and equity, not just the book values, because market values reflect the current cost reality.
Okay, let's try and put some simple numbers to this for you, the listener, just to make it really concrete. Imagine XYZ company. Let's say their common stock costs them 8.4%, their preferred stock costs 6.8%, and their debt carries a 6.0% interest rate. And looking at market values, their capital structure is, say, 55% common stock, 20% preferred stock, and 25% debt.
Yeah.
And let's assume the corporate tax rate is 30%. How do we get XYZ as WACC?
Okay. The first, Absolutely crucial step is to adjust the cost of debt for taxes. Why? Because interest payments are tax deductible.
Right, the tax shield.
Exactly. So we take the 6.0% debt interest rate and multiply it by 1 minus the 30% tax rate. So 6.0% times 0.70, that gives us an after-tax cost of debt of 4.2%. That's the real cost to the company after accounting for the tax savings.
Okay, 4.2%.
Then we plug everything into the WACC formula. It's the weight of common equity times its cost, plus the weight of preferred times its cost, plus the weight of debt times its after-tax cost. So that's host 0.55, 8.4%, plus 0.20, 6.8%, plus 0.25, 4.2%.
Okay, doing the math.
When you run those numbers, XYZ Company's WACC comes out to 7.03%.
7.03%. So that isn't just some abstract number on a spreadsheet, is it? What's the real strategic meaning of that 7.03% for XYZ company?
Precisely. That 7.03% represents XYZ's overall cost of funding itself. It's their financial baseline. If they use this WACC as their hurdle rate, which many companies do, it means they should only invest in new projects that are expected to generate a return higher than 7.03%. This ensures that every dollar they raise and invest is actually working efficiently, adding value, and contributing to maximizing the firm's overall worth.
So WACC isn't just finance jargon. It's like the ultimate internal benchmark. It determines whether a company's big plans for expansion are actually financially sound or maybe just wishful thinking.
Couldn't have said it better myself. It links investment decisions directly back to the cost of funding those decisions.
That makes a lot of sense. And to really grasp WACC, we probably need to quickly touch on how each of those individual component costs, debt, preferred, equity, are determined, right? Because you said they're calculated a bit differently.
Yes, absolutely. Getting those individual costs right is key to getting an accurate WACC. For instance, the cost of debt, as we just saw in the example, is almost always considered on an after-tax basis because that interest is tax deductible.
Let's just quickly illustrate that again. If a firm's pre-tax cost of debt is, say, 12.5% and their tax rate is 30%, what's the real after-tax cost they're actually paying?
Simple calculation. It's 12.5% multiplied by 1 minus 0.30, or 12.5% times 0.7 That brings the actual cost down significantly to 8.75%.
Well, quite a drop.
It really is. And you can see why debt is generally the lowest cost source of capital for a company, especially when tax rates are high. That tax shield makes a big difference.
Okay. And for preferred stock, we mentioned earlier that those dividends aren't tax deductible, so I guess after-tax calculations aren't relevant there. How's its cost figured out?
Correct. No tax adjustment for preferred stock. Its cost is typically calculated quite simply. It's just the annual preferred stock dividend payment divided by the net proceeds the company received when they issued that stock. So, for example, say a company issues a 10% preferred stock with a $100 par value. The annual dividend is $10. But let's say it costs them $5 per share in flotation costs, fees for lawyers, bankers to issue it.
Right, the issuance costs.
So the net proceeds they actually got were only $95, $5. The cost of preferred stock would then be $10 divided by $95, which comes out to about 10.53%. It's usually straightforward because that dividend rate is typically fixed.
Okay, that seems clear enough. Now the last one, the cost of retained earnings. This one always sounds a bit tricky to me because, well, it's money the company already has, right? It's profits they kept. Why does it have a cost?
That's a great question, and it's a really crucial concept. You're right, it's money the company already possesses. But it still has an opportunity cost. Think about it this way, that money belongs to the common shareholders. If the company didn't retain those earnings, it could have paid them out as dividends. The shareholders could have then taken that money and invested it elsewhere, maybe in other stocks of similar risk.
Ah, okay. So the company needs to earn a return on that retained money that's at least as good as what shareholders could get elsewhere.
Exactly. That's the opportunity cost. The cost of retained earnings is the rate of return required by the firm's common stockholders to compensate them for not receiving those earnings as dividends and letting the company reinvest them instead. And because it's an opportunity cost, it's not directly observable. So there are 3 common methods used to estimate it, each looking at it from a slightly different angle.
Okay, let's briefly touch on what each of these 3 methods tries to capture for you, the listener. First up, the Capital Asset Pricing Model, or CAPM. Sounds technical. What's the core idea?
CAPM is probably the most well-known. It basically says the cost of equity, retained earnings, equals the return you could get on a risk-free investment, like a government bond, plus an extra return, a premium, for taking on the risk of investing in that particular company's stock. That risk premium is determined by the stock's beta. Beta measures how much the stock's price tends to move compared to the overall market. A beta greater than 1 means it's more volatile than the market. Less than 1 means less volatile.
So higher beta means higher expected return demanded by investors.
Precisely. Investors need more compensation for taking on more non-diversifiable market risk. So CAPM links the cost of equity directly to the stock's market risk.
Okay, method 2, the discounted cash flow DCF method. This one sounds like it looks more at future dividends.
It does. The DCF approach assumes that a stock's current price is basically the present value of all the future dividends the market expects to receive from it. So this method estimates the cost of retained earnings by taking the expected dividend per share for the next year, dividing it by the current market price of the stock, and then adding the expected constant growth rate of those future dividends. It's essentially calculating the total return shareholders expect to get, part from the dividend yield, part from the growth in those dividends over time.
Got it. And the third one, the bond yield plus risk premium BYRP approach. How does this one work? It sounds like it connects directly to the company's own debt.
That's exactly right. BYRP is often seen as a simpler, maybe more intuitive approach. It starts with the idea that, well, investing in a company's stock is riskier than investing in its bonds.
Makes sense.
So it estimates the cost of retained earnings by taking the company's own pre-tax cost of long-term debt, the yield on its bonds, and then simply adding a risk premium. This risk premium represents the extra return investors typically demand for holding the company's equity compared to its debt. It's a quick way to get a ballpark estimate for the cost of equity, building directly on the firm's own borrowing costs.
So 3 different ways, CAPM, DCF, BYRP, all trying to estimate this somewhat elusive cost of retained earnings. Which one is like the right one to use?
That's the million-dollar question. There's no single method that's universally declared the best. They each have their own underlying assumptions and potential data challenges. Often, financial analysts will calculate the costs using 2 or even all 3 methods. If the results are reasonably close, they might take an average to get a more robust estimate. The key is understanding what each method is trying to capture and being aware of its limitations. The broader impact. Structures influence.
Okay, so we've broken down the components, the WACC calculation, the individual costs. But stepping back, how does finding this optimal capital structure actually play out in a company's real-world decisions and its overall value?
Right. The optimal capital structure, remember, is that specific mix, that ratio of debt to equity that results in the absolute lowest WACC. Finding it is a real balancing act. As a company starts adding debt, initially the WACC often goes down. Why? Because debt is cheaper than equity, especially after taxes.
Okay.
But if a company takes on too much debt, both lenders and equity investors start getting notice about the increased risk of default. They'll start demanding higher returns, higher interest rates on new debt, and a higher required return on equity. This pushes the cost of both components up.
So the WACC starts rising again?
Exactly. If you were to graph it, WACC typically drops as debt increases from 0, hits a minimum point that's your optimal structure, and then starts to climb back up, sometimes sharply, as the risks of financial distress become too high.
And this lowest WACC point, this optimal structure, directly impacts where a company chooses to invest its money, right?
Absolutely. Ideally, new projects should be funded using sources of capital that help maintain this optimal structure over the long run. And crucially, those projects must promise returns that meet or preferably exceed the hurdle rate implied by the company's WACC. However, and this is important, a company's overall WACC might not be the right hurdle rate for every single new project.
Why not?
Well, if a new project is significantly riskier or safer than the company's average activities, or if it fundamentally changes the company's business mix or leverage, then using the overall WACC might be misleading. You might need to adjust the hurdle rate for that specific project's risk, or consider the cost of the specific new capital being raised for that project. It requires judgment.
That makes sense. Now, we focused heavily on capital structure, how a company is funded, but there's also something called asset structure. What exactly is that, and how does it connect?
Good point. Asset structure simply refers to the mix of assets on a company's balance sheet. Basically, what kind of stuff does the company own? We usually break it down into 2 main categories. Current assets, things like cash, accounts receivable, money customers owe them, inventory. These are generally expected to be converted to cash or used up within about a year. And then non-current assets. These are the long-term investments, like property, plant and equipment, factories, machines, intangible assets like patents or brands. These provide benefits over many years.
What's really fascinating here, I think, is how the capital structure, the funding side, influences the asset structure, the investment side, and vice versa.
Yeah.
It seems like they're constantly interacting.
They absolutely are. It's a financial dance, as you said earlier. They're deeply interconnected. When a company raises new capital, say by issuing new debt or equity, what happens? They get an immediate cash infusion. That boosts their current
Yeah.
assets. That new funding can then be deployed to acquire long-term non-current assets, maybe building a new factory, investing in R&D, or even acquiring another company. So capital structure enables changes in asset structure. But then the type of capital chosen also creates future cash demands that impact assets. Debt requires cash outflows for interest and principal payments, potentially draining current assets. Equity may require cash for dividend payments, also reducing cash. So the way you fund yourself directly impacts not just what you can acquire, but also how those acquisitions and funding choices affect your future cash flows and asset base.
This brings us neatly to a very practical point related to debt, loan covenants. These seem really important, especially if you're looking at a company's financial health from a lender's viewpoint or if you're a business owner seeking a loan.
Yes, loan covenants are critical. They are essentially rules or conditions that lenders include in loan agreements to protect their investment. They basically limit the borrower's actions in certain ways to reduce the risk that the lender won't get paid back.
And how does the company's capital structure influence these covenants?
Significantly, if a company has a lot of equity and very little debt, meaning its financial leverage is low, lenders see less risk. In those cases, the loan covenants might be quite minimal, quite lenient, but if a borrower already has a lot of debt relative to their equity, lenders face much higher risk. So the covenants will typically be much more numerous and much more stringent.
Like what kind of things?
Oh, they might restrict the company from taking on more debt or require it to maintain certain financial ratios, like keeping its debt-to-equity ratio below a certain level, or maintaining a minimum level of working capital. Breaking a covenant can trigger serious consequences, even default.
Okay, so beyond the numbers, the ratios, the covenants, how does capital structure affect a company's real-world outcomes?
Hmm.
Things like its growth prospects and its overall profitability.
Well, investors, creditors, potential partners, everyone wants to see sustainable growth and solid profitability. And both of these are profoundly affected by a company's capital structure choices.
Let's start with growth rate. How does funding mix impact how fast a company can grow?
A company's potential growth rate is closely tied to how much of its earnings it retains and reinvests back into the business. Every year, a company generates earnings. It has two basic choices: pay those earnings out to shareholders as dividends, or keep them, retain them, and reinvest them in new projects, assets, or initiatives. The percentage of net income that's not paid out as dividends is called the retention ratio.
So higher retention means more money for growth.
Generally, yes, assuming the company can reinvest those retained earnings profitably. The expected sustainable growth rate is often estimated by multiplying the retention ratio by the company's return on equity, ROE.
So how does capital structure tie in?
Well, first, the dividend payout decision itself is influenced by shareholder expectations and the need for funds. More debt might mean less flexibility to pay high dividends, thus potentially increasing retention. Second, the company's ROE is directly affected by its capital structure. Using debt, leverage can amplify ROE when times are good, but also drag it down if earnings falter due to high interest costs. So, more debt can potentially boost ROE and thus growth, but it also adds risk. It's that trade-off again.
And what about profitability? How does capital structure show up in those common profitability ratios we see?
Profitability measures like return on sales, ROS, return on investment, ROI, return on assets, ROA, and return on equity, ROE, they all reflect the company's performance after accounting for its capital structure decisions. Think about net income, the bottom line. It's calculated after deducting interest expense. So the more debt a company has, the greater the impact of interest expense, which directly reduces its net income and thus affects all those profitability ratios tied to net income.
Right, and ROE is net income divided by equity.
Exactly. So higher debt means lower equity relative to assets, which can boost ROE if net income doesn't fall too much from interest expense. But higher debt also means higher interest expense, which pushes net income down. It's a complex interplay. Dividend payments also reduce assets and equity, impacting these ratios.
This leads us perfectly into a really powerful concept: leverage and risk. We've touched on it, but let's dig in. It seems like leverage can amplify returns, but it also amps up the risk.
That's the perfect way to put it. Leverage is a double-edged sword. It significantly affects how volatile or sensitive a company's profits are to changes in sales or operating conditions, and therefore it affects the risk that creditors and owners assume. Financial managers usually think about two main types of leverage.
Okay, what are they?
First, there's operating leverage. This relates to the company's cost structure specifically, how much it relies on fixed operating costs, like rent, salaries, depreciation on machinery, versus variable operating costs like raw materials, sales commissions. Think of a big manufacturing plant. Huge fixed costs, right? That's high operating leverage. Compare that to, say, a consulting firm where the main costs are salaries, which are somewhat more variable. That's lower operating leverage.
So what's the implication of high operating leverage?
A company with high operating leverage needs to generate a lot of sales just to cover those high fixed costs to reach its break-even point. But once it gets past that break-even point, watch out. Because the fixed costs are covered, each additional dollar of sales revenue leads to a much larger percentage increase in operating income. Profits can soar quickly.
High risk, high potential reward.
Exactly. Imagine Pat Jones's manufacturing company again. Maybe a 5% increase in sales leads to a massive 21% jump in operating income because those fixed costs are already covered. But if sales drop 5%, operating income could plummet.
Okay, that's operating leverage. What's the second type?
The second type is financial leverage. This is the one directly tied to capital structure. It's about the degree to which a company uses debt rather than equity to finance itself. When a firm issues debt, it takes on fixed interest costs, mandatory payments. Equity issuances, on the other hand, don't create those mandatory fixed payment obligations. Dividends are optional.
So similar dynamic to operating leverage.
Very similar impact on profits, yes. A company with high financial leverage, lots of debt, needs to generate enough operating income just to cover its interest payments. But once those interest costs are covered, any additional operating income flows straight down to net income and earnings per share, EPS, magnifying the returns for shareholders. Plus, remember, interest is tax deductible, which adds another benefit.
But the downside is also magnified.
Absolutely. High financial leverage dramatically increases the risk of bankruptcy if the company hits a downturn and can't make its debt payments. It also makes it harder and more expensive to find new lenders if needed. So if that firm with lots of debt sees its operating income jump 21%, its EPS might leap by, say, 42%. That's financial leverage magnifying the upside. But a drop in operating income could wipe out EPS entirely.
So wrapping this leverage idea up, what does it all mean for a firm's overall value? How does using debt actually add value, if at all?
Right. We often talk about a levered firm, one that has debt, versus an unlevered firm, one that uses only equity. The key insight, going back to taxes, is that a firm using debt benefits from the tax deductibility of its interest payments. This tax shield has real, tangible value. You can think of the value of these cumulative tax savings, discounting back to today's dollars, as the extra value that debt adds to the firm, compared to if it were purely equity financed.
Can you give a quick example?
Sure. Let's say an unlevered firm, all equity is worth $130 million. Now imagine it takes on $25 million in debt, and its tax rate is 30%. The value of the tax shield created by that debt is the tax rate times the amount of debt, so 30% of $25 million, which is $7.5 million. So the value of the levered firm would theoretically be the unlevered value plus the value of the tax shield. $130 million plus $7.5 million was $137.5 million.
Wow. So the debt, purely because of the tax shield, adds $7.5 million to the firm's total value in this simple model.
Exactly. That's the theoretical value added by leverage, driven primarily by the tax benefit of debt in many models. Of course, this ignores potential bankruptcy costs that arise if leverage gets too high, but it shows the fundamental value proposition.
What an illuminating deep dive into capital structure. Wow. From those basic building blocks of debt and equity, through the intricate calculations of WACC, and then understanding the powerful double-edged sword of leverage, it's so clear this isn't just some dry accounting concept. It's absolutely central to business strategy, to risk management, and really the very foundation of how companies fund themselves and grow.
Indeed. I think understanding these dynamics truly arms you, the listener, with incredible insight. You can see how companies are structured for growth, the calculated risks they're taking, and ultimately, how they aim to create and maximize value. It really highlights that constant, delicate balancing act between minimizing cost, maintaining control over the company, and managing financial risk.
We certainly hope this deep dive has given you a much clearer picture of it all, and maybe even sparked some new questions for you to explore on your own.
And it's always worth remembering that the optimal capital structure isn't some fixed target you find once and stick with forever. It's a dynamic decision. Companies are, or should be, constantly reevaluating their financing mix based on changing market conditions, their own evolving growth plans, shifts in interest rates, tax laws, and even their own changing tolerance for risk. It's truly a living, breathing part of any successful enterprise.
Couldn't agree more. Well, thank you for joining us on the deep dive. Until next time, keep learning, keep questioning, and stay well informed.